Picture this scenario. It is the morning of Friday, January the 2nd, 2026. The holiday lights are coming down, the markets are reopening, and the world is getting back to work. But inside the investment committee boardrooms of the largest pension funds in the United States, the mood is not celebratory. It is frantic. You are looking at a room full of highly paid asset managers, actuaries, and compliance officers who have just realized they are walking into a mathematical trap. These are the people managing the retirement savings of millions of Americans. Teachers, firefighters, steelworkers, and nurses. They control billions of dollars in capital, and they are staring at a document that tells them they have to do something impossible. The document is their annual rebalancing mandate. It is not a suggestion. It is not a piece of advice from a consultant. It is a binding legal instruction written into the fund's bylaws. It dictates exactly how the portfolio must be allocated at the start of the fiscal year to maintain compliance with risk standards. And this year, that document is telling them to buy the one asset they don't own. It is telling them to buy silver, billions of dollars worth of it. And it is telling them to start buying it immediately, regardless of the price and regardless of whether there is any metal actually available to buy. Here is what most people outside the institutional finance world do not understand about how this system works. We tend to think of investing as a choice. We think these managers sit around, analyze charts, look at earnings reports, and decide what they like. That is how retail investors think. That is how day traders think. But that is not how a $50 billion pension fund operates. At that level, investing is not an art. It is a bureaucracy. It is a series of mechanical triggers and automated compliance rules. When a specific asset class outperforms everything else by a wide margin, the rules do not say, congratulate yourself. The rules say, you are now underweight. The rules say, you have missed the boat, and your risk profile is now out of alignment with your charter. The only way to fix that alignment legally is to buy the asset that went up. You have to chase it. You have to balance the scales. And in 2024, the asset that broke the scales was silver. This is where the nightmare begins for the investment committee. They spent 2024 sitting in bonds that lost purchasing power. They spent 2024 holding stocks that looked dangerously expensive. They ignored silver because, for decades, silver was seen as a dead asset, a pet rock for conspiracy theorists. But while they were ignoring it, silver quietly climbed 67%. It became the best performing major asset class of the year. Now, fast forward to January 2nd. The performance numbers are finalized. The auditors have signed off. The algorithms that determine asset allocation have finished their calculations. And the computer has spit out a buy order. It says the fund has zero exposure to the year's best hedge against inflation. It says the fund is non-compliant. To return to compliance, the fund must allocate a specific percentage of its surplus capital into the metal. This wouldn't be a problem if we were talking about treasury bonds. The bond market is massive. You can buy billions in seconds. It wouldn't be a problem if we were talking about the S&P 500. But we are talking about silver, a market so physically small that a single large hedge fund could corner it over a long weekend. And now, we aren't talking about one hedge fund. We are talking about the entire U.S. pension system waking up on the same morning with the same mandate to buy the same limited asset. Let's talk about the scale of this problem because the numbers are staggering. We are not talking about pocket change. We are talking about a wall of money that has no place to go. When these managers look at their balance sheets, they see a surplus, a massive pile of cash that sits there, earning nothing, losing value to inflation every day it sits idle. In the world of pension management, having too much cash is actually a liability. It drags down performance. It makes you look incompetent. You have a fiduciary duty to deploy that capital. So you have the surplus, you have the mandate, and you have the deadline. January is not just another month. In the institutional calendar, January is the Great Reset. It is when the biggest trades of the year happen. It is when portfolios are structured for the next 12 months. If you miss the window in January, you are playing catch-up for the rest of the year. No manager wants to explain to their board in December why they missed the trend in January. This creates a psychological pressure cooker. Every manager knows that every other manager is looking at the same data. They know that if they wait until January 5th, the price might be higher. If they wait until January 10th, the supply might be gone. So they don't wait. They don't try to time the dip. They hit the buy button at the market open on January 2nd. But here's the catch. When they hit that button, they aren't buying paper shares of an ETF that tracks a spreadsheet. The new mandates, driven by the failures of 2024, specifically require allocated physical exposure. They need to prove they own the metal. They need bar numbers. They need vault receipts. They need assurance that if the financial system cracks, their retirees still have an asset that exists in the real world. This distinction between paper exposure and physical allocation is what turns a normal rally into a liquidity crisis. You can print as many paper silver contracts as you want. Wall Street is very good at creating paper derivatives. But you cannot print a 1,000-ounce silver bar. You have to mine it, refine it, pour it, stamp it, and ship it. That process takes time. It takes energy. It takes geology. And right now, the geology is not cooperating with the bureaucracy. The managers on the committee are looking at their screens, and they are seeing the disconnect. They see the price on the COMEX futures market, and it looks stable, but then they call their bullion banks. They call the vaults in London and New York, and they ask to secure physical delivery for their January allocation. And there's a pause on the other end of the phone. The bullion banker clears his throat. He says, "We can get you the exposure, but there's a delay on delivery." He says, "The premiums are running a little high." He says, "We might need to source this from multiple locations." These are polite ways of saying, "We don't have the metal." This is the moment the realization hits. The pension fund has a mandate to buy $500 million worth of silver by the end of the month. But the market only has $50 million available for immediate delivery. The math is broken. The mandate is absolute. The compliance officer is tapping his watch. And the price is about to do something that hasn't happened in 40 years. This is the setup. This is the scenario. It is not speculation. It is the inevitable result of a mechanical process colliding with a physical reality. The surplus capital is real. The bylaws are written. The date is set. The only variable left is the price. And as we are about to see, when you force a river of money through the eye of a needle, the pressure doesn't just rise, it explodes. Let's dig deeper into why this mandate exists in the first place. Well, why are pension funds, which are historically the most boring and conservative investors on the planet, suddenly scrambling to buy a volatile metal like silver? To understand this, you have to understand the death of the strategy that kept them safe for 40 years. It's called the 60-40 portfolio. For decades, the rule was simple. You put 60% of your money in stocks to capture growth. You put 40% of your money in bonds to provide income and safety. When stocks crashed, bonds usually went up, so the two balanced each other out. It was a perfect seesaw. It required very little thinking. You just set it, rebalanced it once a year, and went to play golf. This strategy is the bedrock of the entire Western retirement system. But in 2022, 2023, and especially 2024, the seesaw broke. Both ends went down at the same time. Inflation drove interest rates up, which crushed bond prices. At the same time, economic uncertainty and high valuations made stocks volatile. Suddenly, the safe part of the portfolio, the bonds, was losing money just as fast as the risky part. This was a catastrophe for pension fund managers. They looked at their 10-year treasury bonds, the so-called risk-free return, and realized that after inflation, they were losing purchasing power. If a bond pays you 4% interest, but inflation is running at 5% or 6% in real terms, you're not investing. You are slowly going broke. You are guaranteeing that your retirees will be poorer in 10 years than they are today. So, the investment committees started looking for a third leg for the stool. They needed something that wasn't correlated to stocks and wasn't destroyed by inflation. They needed an asset that actually performed when the dollar got weaker. They looked at real estate, but commercial real estate was crashing. They looked at crypto, but it was too volatile for their regulatory guidelines. And then they looked at precious metals, and this is where the performance trap snaps shut. In the world of institutional investing, past performance dictates future allocation. It is a concept called momentum investing baked into their risk models. The models assume that if an asset class rises significantly while maintaining liquidity, it is experiencing a structural repricing. The model interprets the price rise as a signal of quality. Pop quiz. What was the best performing major asset class of 2024? If you said tech stocks, you're wrong. If you said Bitcoin, you're thinking too narrow for a pension fund. Silver gained 67% last year. It outperformed the S&P 500. It outperformed the NASDAQ. It outperformed the bond market by a landslide. While silver was making this historic run, where were the pension funds? They were on the sidelines. They had exactly zero exposure. They missed the entire move. And in the competitive world of fund management, missing a 67% gain is a fireable offense. It creates a performance gap that shows up in every quarterly review. Now, imagine the conversation with the board of directors. The board asks, "Why is our fund underperforming the benchmark?" The manager has to answer, "Because we didn't own the best performing asset of the year." The next question from the board is immediate and aggressive. "Well, are we buying it now?" The answer has to be yes, not because they like silver, not because they are gold bugs or believers in sound money, but because the rules of career survival and regulatory compliance say they must fix the gap. They have to chase the performance. This is what we call indiscriminate buying. Indiscriminate buying is a trader's term. It means the buyer is not price sensitive. A normal investor looks at a chart and says, "Silver is up 67%. Maybe I should wait for a pullback. Maybe I should wait for it to get cheaper." A pension fund under a mandate does not think like that. They think, I need to allocate 2% of the fund to silver by January 31st to meet my target. If the price goes up $5 tomorrow, they still buy. If it goes up $10 the next day, they still buy. In fact, as the price goes up, their allocation models might tell them to buy more because the asset is becoming a larger part of the global market cap. It is a feedback loop. Higher prices trigger more buying, which drives higher prices. This is exactly what happened with tech stocks in the late 1990s. Pension funds had to own them because they were going up. But tech stocks are intangible. You can create an infinite number of shares. You can split stocks. You can issue new equity. There is no physical limit to how much Apple or Microsoft stock can exist. Silver is different. You cannot issue new silver. You cannot split a silver atom to make 2 ounces out of one. The supply is fixed by geology and mining capacity. So when you apply that same momentum chasing model to a finite physical element, you don't just get a bubble. You get a breakage. You get a situation where the money is demanding something that reality cannot provide. The investment committees know this. They aren't stupid. They read the reports. They know mining supply is flat. They know demand is record-breaking. But they are trapped by their own bureaucracy. Their mandates don't have a clause that says, stop buying if supply is tight. The mandates just say, buy. And they have to buy specifically in January. Why? Because of the window dressing effect. At the beginning of the year, funds want to show a fresh, optimized portfolio to their clients and beneficiaries. They want to say, look, we have positioned ourselves for the new year. We own the winners. We have hedged the risks. They cannot show up in Q1 reports holding the same losing bonds from last year. They have to show action. They have to show that they have pivoted. And the pivot for 2026 is into hard assets. The 60-40 is dead, replaced by something that looks more like 50-30-20, stocks, bonds, and commodities. That 20% slice for commodities is the killer. Even if they don't do 20%, even if they only do 5% or 1%, the sheer amount of capital involved in a 1% allocation from a $1 trillion pension system is enough to wipe out the available silver inventory 5 times over. So, as we approach January the 2nd, we are watching a slow-motion collision. On one side, you have a failed investment strategy, 60-40, that is forcing managers to look for alternatives. On the other side, you have a rigid mechanical rulebook that forces them to buy the winner of 2024. And in the middle, you have a tiny, neglected, physically scarce market called silver that is about to get hit by a freight train of capital. Now that we understand the motivation, let's look at the ammunition. You might be thinking, do these pension funds even have the cash to make these moves? Aren't they all broke? And that is the common narrative. We always hear about underfunded pensions. But in a twist of financial irony, 2024 created a bizarre anomaly that has filled these funds with more cash than they have seen in 15 years. And that cash is the fuel for the fire. The specific data comes from the Milliman Corporate Pension Funding Study. This is the gold standard for tracking the health of the 100 largest corporate defined benefit pension plans in the U.S. These are the giants, companies like IBM, Ford, General Motors. Their pension funds are massive market movers. According to the Milliman report, something extraordinary happened in 2024. The funding ratio of these pension plans skyrocketed. They started the year at roughly 99.5% funded. That means for every dollar they owed to future retirees, they had about 99.5 cents in the bank. That is considered healthy. But by the end of 2024, that number jumped to 105%. This swing created a surplus. A massive tangible surplus of approximately $68 billion in excess capital. This is money that is extra. It is above and beyond what they need to pay out current liabilities. It is pure investable firepower. Why did this happen? It's a combination of high interest rates, reducing the calculated value of future liabilities, and the stock market holding up better than expected. But we don't need to get bogged down in the actuarial math. We just need to focus on the result. $68 billion sitting there, burning a hole in their pockets. You might think, great, they have a surplus, they can just save it. But that is not how institutional finance works. In the pension world, there's a concept known as asset-liability matching. If you have a surplus, you are under tremendous pressure to lock it in or deploy it into assets that will protect that surplus against future inflation. If a manager leaves that $68 billion in cash and inflation spikes again in 2026, the real value of that surplus evaporates. The surplus is an opportunity, but it is also a risk. It is a use it or lose it situation. The investment committees are looking at this $68 billion and asking, where does it go? They cannot put it back into bonds because, as we discussed, yields are barely beating inflation. They are terrified of putting it into the S&P 500 at all-time highs because a 20% correction would wipe out the surplus overnight. They need an asset that is unloved, undervalued, and inversely correlated to financial collapse. This brings us back to the Milliman data. This is the first time in over a decade that the system has had this much surplus capital requiring allocation all at once. In previous years, pension funds were in deficit mode. When you are in a deficit, you are playing defense. You are trying to squeeze out returns just to keep the lights on. You are managing liquidity to pay checks. But when you are in surplus mode, you play offense. You look for strategic acquisitions. You look for diversification. You have the luxury of buying assets that might not pay off for 5 or 10 years, but which offer massive protection. This is the exact psychological state required to buy physical precious metals. Metals don't pay dividends. They don't pay interest. For a deficit fund, that is a problem. But for a surplus fund, that is irrelevant. The surplus fund doesn't need income today, needs purchasing power protection for tomorrow. Silver fits that profile perfectly. Now, let's do the math on that 68 billion. The entire annual mine supply of silver is roughly 830 million ounces. At $30 an ounce, that's about 25 billion. That is the whole pie. Every mine in Mexico, Peru, China, Russia, Australia, combined, the surplus capital from just the top 100 US corporate pensions, $68 billion, is nearly 3 times the value of every ounce of silver mined on Earth in a year. And that's just the surplus. That doesn't count the trillions of dollars in their base assets. That doesn't count public pensions like CalPERS. That doesn't count sovereign wealth funds. That doesn't count insurance companies. We are looking at just the extra cash from one sector of the US market. If they decide to allocate just 10% of that surplus to silver, a tiny conservative move of roughly 6.8 billion, that would effectively absorb 25% of the world's annual supply. Just like that, in one stroke of a pen. But remember the mandate. They aren't just looking to spend the surplus. They are looking to rebalance the entire portfolio. The surplus just gives them the liquidity to do it aggressively without selling other assets. It greases the wheels. It removes the friction. Usually, to buy something new, a fund has to sell something old. That creates market impact and takes time. But with the Milliman surplus, they have dry powder. They can write the check on January the 2nd without selling a single stock or bond. This makes the buying wave faster, sharper, and more violent. The compliance officers are looking at this surplus and saying, this is our chance to fix the structural weakness in our portfolio. They see the deficits in the government. They see the debt spiraling to 36 trillion. They know that eventually the dollar will be debased to pay for it. They view this $68 billion surplus as a lifeboat. And they are not going to build the lifeboat out of paper dollars. They want to build it out of hard assets. This is why the January 2nd date is so critical. The surplus was confirmed at year end. The books are closed. The money is officially there. The managers return from the holiday break with a green light. They have the motive, inflation. They have the mandate, rebalancing. And thanks to the surplus, they have the means. It is a perfect alignment of financial forces, and it is aiming directly at a market that is utterly unprepared for it. The silver market is used to retail investors buying a few coins, or industries buying a few tons. It is not used to a $68 billion wall of institutional capital looking for a home. When that capital hits, it won't be polite, it won't be gradual, it will be a shock to the system. And it serves as the final proof that the smart money is no longer asleep at the wheel. They are awake, they are flush with cash, and they are panicked about the future. We have established the why, the mandate, the when, Jan 2nd, and the with what, the surplus. Now we have to talk about the where. Where is this metal supposed to come from? This is where the story shifts from financial theory to physical logistics. This is where we encounter the doorway crisis. Imagine you're trying to push a crowd of 50,000 people through a single revolving door in 10 minutes. It doesn't matter how rich the people are. It doesn't matter how badly they want to get in. The physics of the door determines the flow. If you push too hard, the door jams. People get crushed. The system fails. The silver market is that revolving door. And the pension funds are the crowd. Let's put the numbers in stark perspective. The global silver market is tiny. It is shockingly small compared to other assets. The annual mine production is worth about $25 billion at recent prices. Apple, the company, generates more than that in cash flow in a single quarter. The entire annual supply of silver is a rounding error on the balance sheet of a major bank. Now, we have these pension funds looking to deploy potentially $50 billion or more into this sector to meet their rebalancing mandates and hedge their liabilities. Think about that math. They are trying to buy twice the annual global production. But wait, it gets worse. That $25 billion of annual supply isn't just sitting there waiting for investors. It is already spoken for. Industrial demand consumes nearly all of it. Solar panels, electronics, electric vehicles, medical devices. They gobble up the silver as soon as it leaves the ground. We have been in a structural deficit for 5 years. We consume more than we mine. So the room isn't just small, it's already full. There is no empty space for the pension funds to step into. When they come with their $50 billion buy orders, they aren't buying new supply. They have to bribe existing holders to give up their metal. They have to price the metal high enough to convince a solar manufacturer to sell their inventory, or to convince a long-term investor to sell their stack. This is price discovery, but in a shortage, price discovery isn't linear. It's exponential. Now, let's look at the vaults. The London Bullion Market Association, LBMA, and the COMEX in New York are the two main hubs for silver storage. These are the savings accounts of the global silver market. If production isn't enough, you draw from the vaults, but the vaults are emptying. London Silver Holdings hit 226 metric tons of available inventory by the end of 2024. That sounds like a lot until you realize it was over 30,000 tons just a few years ago. That is a drop of nearly 30% in available inventory. The trend line is a terrifying slope downwards to the right. The Bank for International Settlements, BIS, tracks this. They are worried. They know that these vaults provide the liquidity for the entire paper trading scam. If the vaults go to zero, the paper contracts become worthless because they cannot be settled. So, on January the 2nd, the pension funds call the bullion banks in London. They say, we need to allocate $500 million to physical silver. The bullion bank looks at the vault. The vault is empty, or the metal inside is already leased out to someone else. The banker cannot say no. Banks don't say no to billions of dollars. Instead, they scramble. They try to lease metal from an ETF. They try to swap location with a vault in Singapore. They try to offer a synthetic position. But remember, the mandate says allocated. The pension fund needs title to the metal. This is where the doorway jams. The money is pushing, but the metal isn't moving. We saw a preview of this in October 2024. Physical premiums on silver eagles hit 90 over spot. Why? Because the mints couldn't get silver blanks. Dealers were literally putting silver on airplanes, commercial passenger jets, flying it between London and New York. Do you understand how insane that is? Silver is heavy. It is expensive to fly. You usually put it on a slow boat. But when the shortage is this severe, time becomes more valuable than shipping costs. Traders were paying exorbitant air freight just to get metal into the right vault to satisfy a delivery demand. And that was just a tremor. That was just a few hedge funds and retail buyers. That wasn't the pension system. When the pension system arrives, they won't be flying a few pallets. They will be trying to source thousands of tons. The logistics simply do not exist. You cannot mine it faster. It takes 10 years to build a new mine. You cannot recycle it faster. Most silver in electronics is lost in landfills because it's too expensive to recover. So the only valve that can release the pressure is price. The price has to rise to a level where it destroys demand from someone else. It has to go high enough that maybe the jewelry makers stop buying, or maybe the silverware makers stop producing. But the solar companies can't stop. They need it for efficiency. The pension funds can't stop. They have a legal mandate. This creates a bidding war between a blind giant, the pension fund with a mandate, and a desperate builder, the industrial user. The blind giant will pay any price because the rules say so. The desperate builder will pay any price because without silver, their factory closes. This is why the $25 billion market size is the most dangerous number in finance right now. It is too small to handle the flows. It is a teacup trying to catch a waterfall. When you force $50 billion through a door built for $25 billion, the door frame shatters. In financial terms, shattering the door frame means the collapse of the paper pricing mechanism. It means the spot price on your screen stops reflecting reality. It means the spread between paper silver and real silver blows out to $10, $20, maybe $50 an ounce. It means that unless you have the metal in your hand or your own private vault, you don't really own it. Because when the pension funds come to claim their allocation, they are going to take everything that isn't bolted down. They are the whales, and they are hungry. The supply crisis is not a theory. It is simple arithmetic. We have the numbers on production. We have the numbers on the deficit. And now, thanks to the Milliman study and the rebalancing mandates, we have the numbers on the demand. The two sides of the equation do not balance. And on January 2nd, the market is going to try to force them to balance in the most violent way possible. We have looked at the human element, the pension managers. We have looked at the physical element, the vaults. Now we must look at the digital element. In modern markets, the vast majority of trading is not done by humans. It is done by algorithms, passive indexes, and automated execution systems. And for the silver market, the calendar from January the 2nd to January 10th, 2026 represents a digital firing squad. Traders are calling this the perfect storm window. It is a span of 8 trading days where 3 distinct automated forces will converge on the silver market simultaneously. Any one of these would be bullish. All 3 together are explosive. First, let's talk about the execution window. As we discussed, investment committees make their decisions in December. They approve the strategy, but they don't trade during the holidays. Liquidity is too thin. The senior traders are in Aspen or St. Bart's. The purchase orders sit on the desk, signed and stamped, waiting for the new year. On the morning of January the 2nd, the senior traders return. They have a stack of orders to execute. These aren't just market orders where they buy everything at once. They are volume-weighted average price, VWAP orders. They are programmed to buy steadily throughout the day and the week to build the position. This means that from the opening bell on Jan 2nd, there is a relentless robotic bid under the market. Every time the price dips, the pension fund algorithms step in to buy more to fill their quota. This removes the downside. Short sellers, who usually rely on smashing the price to trigger stops, will find that their selling pressure is instantly absorbed by this wall of passive buying. It creates a floor under the price that rises every single day. Second, we have the quarterly rebalancing. It's not just the annual pension mandates. It is the quarterly resets for sovereign wealth funds, endowments, and managed accounts. According to Bloomberg's institutional trading calendar, the first 10 days of January see the heaviest rebalancing volume of the entire year. In previous years, this meant selling winners and buying losers. But remember, for the first time in decades, the winner is a commodity, silver, and the losers are financial assets, bonds, stocks. So the flow is reversed. The algorithms are programmed to sell S&P 500 futures and buy commodity futures. This rotation is massive. We are talking about trillions of dollars in assets that track these models. Even a 0.5% rotation is seismic. And it happens automatically. No human needs to push a button. The code simply executes the rebalance to bring the weightings back in line. Third, and perhaps most dangerous, is the index multiplier effect. This is the part almost no one talks about. Major commodity indices, like the Bloomberg Commodity Index, BCOM, or the S&P GSCI, have rules about how they weight different components. These rules are often based on liquidity and past performance. Because silver gained 67% in 2024 and saw a rising volume, the index methodology dictates that silver's weighting in the index must increase for 2026. This is a mechanical adjustment. It happens in early January. When the index increases the weighting of silver, every ETF, every mutual fund, and every structured product that tracks that index must buy more silver to match the new weighting. They have no choice. They are legally required to track the index with minimal tracking error. According to State Street's Commodity Fund Flows data, we estimate approximately $5 to $10 billion in purely passive capital will be forced into silver purchases just from this index rebalancing. This is mindless money. It doesn't care if silver's $30 or $50, it just buys to match the spreadsheet. Now, combine these three forces. Force 1, active pension funds buying to fix their shortage, the mandate. Force 2, global macro funds rotating out of stocks, shares, bonds, the quarterly rebalance. Force 3, passive index funds buying to match new weightings, the multiplier. You have active money, tactical money, and passive money all hitting the buy button in the same 8-day window. And who is on the other side of the trade? Who is selling? The miners aren't selling, they are holding back supply, hoping for higher prices. The stackers aren't selling, they are holding for the moon. The industrial users aren't selling, they are panic buying. The only sellers are the paper shorts, the banks and hedge funds that trade futures contracts. But here's the trap for them. Usually they can short the market to drive the price down and scare away buyers. But you cannot scare away an algorithm that has a mandate. If a bank shorts silver to push the price down $2, the pension algorithm just sees a better entry price and buys more. The index fund buys more. The short seller gets exhausted. They run out of ammo. And then they have to cover. When the short sellers realize they are trapped, that the buying isn't stopping, they panic. They switch from selling to buying to close their positions. This is a short squeeze. And in a market as thin as silver, a short squeeze during a period of mandatory institutional buying is like throwing gasoline on a bonfire. The perfect storm window of John 2:10 is when the price discovery mechanism breaks. We could see days where silver moves $3, $5, or $7 in a single session. We could see trading halts on the COMEX. We could see the limit up breakers hit, pausing trading because the price is moving too fast. And remember, this is all happening before the industrial crisis of Q2 even begins. This is just the financial players positioning themselves. This is just the paper shufflers realizing they need hard assets. For the average observer, it will look like mania. The media will call it a bubble. They will say Reddit traders are at it again. But it won't be Reddit. It won't be retail. It will be the rigid, unthinking, unstoppable force of institutional algorithms executing a mandate that simply says, buy silver, now. This 8-day window is the ignition point. It sets the floor for the rest of the year. Once the price gaps up in January, it changes the psychology of the entire market. The $30 silver is gone, the $50 silver becomes the new baseline, and the chase is officially on. What happens when the dust settles on January 10th? Does the price crash back down? Do the pension funds sell and take their profits? This is the most crucial question, and the answer lies in understanding the difference between a trade and a strategic allocation. In 1980, when the Hunt brothers tried to corner the silver market, it was a speculative trade. They used leverage. When the regulators changed the margin rules, the Hunts were forced to sell and the price crashed. That is the history everyone remembers. That is the ghost that haunts silver investors. But this time is fundamentally different. Pension funds are not using leverage. They are buying with cash, that $68 billion surplus we discussed. They are not speculating on a quick flip. They are buying for long-term liability matching. This means they intend to hold the metal for 10, 20, or 30 years to pay out future retirees. This capital is sticky. Once it enters the silver market, it does not leave. It goes into a vault and it stays there. It is effectively removed from the circulating supply forever. So the price spike in January isn't a bubble that pops. It is a repricing that sticks. It establishes a new reality. And this new reality triggers the next phase of the crisis, which is far more profound than just financial numbers. We are watching the transformation of silver from a precious metal into a strategic asset. As the price climbs through $50, $75, and towards BNP Paribas' target of $100, the industrial users we mentioned earlier, the solar panels, the EVs, the defense contractors, start to panic. They realize that the pension funds have vacuumed up the floating supply. They realize the vaults are empty. Suddenly, silver is not just expensive, it is unavailable. A solar factory in China or a missile guidance manufacturer in Arizona can't source the raw material. This is a national security issue. This is when the governments step in. You will see the Department of Commerce and the Pentagon reclassify silver. It will move from the list of investments to the list of critical minerals. We are already seeing this with copper and lithium. Silver is next. Once it is a strategic asset, the rules of the free market are suspended. We might see export bans. Mexico and Peru could say, we are no longer exporting raw silver. We need it for our own industries. We might see the return of strategic stockpiles, where the U.S. government starts buying to ensure the defense industry has enough metal for the next decade. This government buying competes directly with the pension buying. Now you have the state versus the pension funds versus industry. Three giants fighting over a scrap of meat. For the retail investor, the regular person watching this on YouTube, this is the most dangerous and the most profitable moment in history. It is dangerous because if you wait for the pullback, you will be left behind. The institutional buy programs don't allow for deep pullbacks. They buy the dips automatically. But it is profitable because the repricing is just beginning. We are not talking about a 20% gain. We are talking about a multiples gain. When an asset transitions from ignored to mandatory, the price doesn't just double, it finds a new paradigm. Think about the arithmetic one last time. $50 trillion in global pension assets, $50 billion trying to enter in January, a $25 billion annual market, a 5-year structural deficit. The math implies a price that is significantly higher than today. The math implies that silver at $30 or $40 is a historical anomaly that is about to be corrected by the brute force of capital flows. The January 2nd mandate is the trigger. It is the moment the key turns in the lock. The pension funds didn't want to be here. They wanted to stay in their comfortable bonds and stocks. But the surplus, the inflation, and the bylaws have forced their hand. They are coming for the silver, not because they want to, but because they have to. The mechanism is in motion. The deadlines are set. The purchase orders are written. The only question left is, do you own the metal before they do? Or will you be the one trying to buy it from them at $100 an ounce? Our pension funds are about to learn an expensive lesson about the difference between paper wealth and physical assets. They are about to find out that you cannot print silver. You cannot quantitative ease a mine into existence. And you cannot rebalance a portfolio with an asset that isn't there. This is not a drill. This is not a forecast. This is the schedule. January 2nd is the day the pension mandate changes the silver market forever. The clock is ticking. Are you ready? Our